A breakdown guide to understanding your net worth. Understanding net worth. A net worth statement or balance sheet is designed to provide a picture of the financial soundness of your business at a specific point in time. Net worth statements are often prepared at the beginning and ending of the accounting period, that is January 1st, but can be done at any time. The statement records the assets of the business and their value, and the liabilities or financial claims against the business and its debts. The amount by which the value of the assets exceed the liabilities is the net worth, equity, of the business. The net worth reflects the amount of ownership of the business by the owners. The formula for computing net worth is assets, liabilities equals net worth. Likewise, the following formula helps explain the interaction of the elements of the statement. Assets equals liabilities plus net worth. Assets are often divided into three categories: current, intermediate and long-term. In some situations, the intermediate and long-term asset categories are combined into one category called fixed assets. Current assets consist of cash and near-cash assets. Current assets often contain assets that will be sold and converted to cash during the upcoming accounting period. Crops and livestock held for sale are typical current assets for a farm business. Intermediate assets have a useful life of more than 1 year. Typical farm intermediate assets are machinery, equipment and breeding livestock. Long-term assets include real estate such as land, buildings and facilities. These are assets commonly referred to as real estate. Liabilities are usually classified the same way assets are classified. Current liabilities consist of payments that are due during the upcoming accounting period. This includes accounts payable and interest and loan payments due during the accounting period. Intermediate liabilities consist of outstanding debt against intermediate assets and often have a term of 3 to 7 years. Interest and principal payments due within the coming year are included in current liabilities. Only the amount of debt remaining after the current year's principal payment is deducted is included in intermediate liabilities. Long-term liabilities consist of outstanding debt against long-term assets and may have a term of 20 or more years. Interest and principal payments due within the coming year on this debt are included in current liabilities. Only the amount of debt remaining after the current year's principal payment is deducted is included in long-term liabilities. Current assets and current liabilities provide an indication of the cash flow of the business during the coming year. Subtracting current liabilities from current assets determines the amount of working capital in the business. Working capital is the amount of money used to facilitate the operations of the business. Dividing current assets by current liabilities provides a ratio indicating the amount of cash available per dollar of current liabilities. For example, a current ratio of 2:0 indicates there is $2 of cash, or near cash assets, available for every $1 of liabilities due during the coming year. Valuing assets. A value is placed on assets on the day the net worth statement is created. There are two methods for valuing assets. The market approach is commonly used in a simple net worth statement for small businesses. The cost approach is a more sophisticated method often used for large and complex businesses. Both methods may be used in the same statement showing two estimates of net worth. Want to get paid to use social media? Click the link in the pinned comment to get started. Like, share, comment, subscribe and hit the bell to get notified when we release more content.